$5,171. That is where gold closed this week, a new all-time record. And here is the part that should have every serious investor sitting up straight right now. The US dollar index is sitting at 99.70 at the same time. For 30 years, the rule was simple. Dollar goes up, gold goes down. Dollar goes down, gold goes up. That relationship was so reliable that entire trading strategies were built on it. And this week, in live market conditions, with Middle East conflict escalating and oil crossing $100 a barrel, that rule just broke. That is what this video is about. Last week I told you to watch the Shanghai Gold Premium as the key signal for whether Eastern physical demand was adding genuine structural support to the gold price or whether this rally was purely paper-driven. Here is what happened. The Shanghai Gold Exchange spot price came in at $5,208.40 this week, a $37.28 premium over the Western price. That is 0.72% above what you are paying in New York or London. The call was valid. Eastern physical demand is real, and it is showing up in the pricing data right now. My name is John. I am 15 years in FX and commodities. I left that world because I believe the people watching their savings from home deserve the same level of analysis the institutions were getting. I have watched gold rally before. I have watched it fall before. And I have learned to pay very close attention when the normal rules stop working, because that is almost always when the most important things are happening. Everything I show you today comes from publicly available sources, and I will name every single one as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today is part of a bigger picture we are building week by week. Here is what you are going to understand by the end of this video. 1. What the dollar-gold decoupling actually means mechanically, and why it matters more than the headline price record. 2. What $100 oil does to the inflation picture, and why that changes the calculus for gold holders specifically. 3. How to use the 3 lanes framework to read this week's setup clearly, so you know what to watch going forward. Stay with me because around the 8-minute mark, I am going to show you something in the Treasury yield data that most channels are completely missing this week, and it reframes the entire safe haven story. Gold is at $5,171.12 right now. Let that number sit for a moment. A year ago, this price would have seemed extraordinary. Today, it is the new baseline, and the market is asking whether it holds. What triggered this video specifically is not the price itself. It is the combination of conditions surrounding it. Oil crossed $100 a barrel this week. Middle East tensions have escalated in a way that futures markets are pricing as a genuine sustained risk, not a short-term spike. And through all of that, gold has not just held, it has made new highs. If you are holding gold in a SIPP in the UK or a gold IRA in the US right now, you felt every dollar of that move. The question is not whether to feel good about it. The question is whether you understand what is actually driving it, because that determines whether the setup continues or reverses. Now let me explain why the dollar-gold decoupling is the most important thing happening in this market right now, because this is where I want to spend real time with you. The traditional relationship between the dollar and gold is rooted in a simple mechanic. Gold is priced in dollars globally. When the dollar strengthens, every other currency weakens against it, which means gold becomes more expensive in those currencies, which reduces demand from non-US buyers, which pushes the price down. That is the mechanism. It is real. It works most of the time. The US dollar index right now is at 99.70. That is not a weak dollar. That is a dollar with genuine strength behind it. And gold is at an all-time high anyway. So what is happening? Think of it like a building with 2 separate fire alarms. Normally, only one goes off at a time. The inflation alarm rings, gold responds. The deflation alarm rings, dollar responds. This week, both alarms are going off simultaneously. Oil at $100 is ringing the inflation alarm loud and clear. Geopolitical escalation in the Middle East is ringing a completely different alarm, the war risk alarm, and that one does not care what the dollar is doing. Investors are not choosing between gold and dollars right now. They are holding both. That is the decoupling. And in 15 years watching these markets, I can count on one hand the number of times I have seen this setup, where gold and the dollar both strengthen together in response to the same event cluster. Every single time it has happened, it has been because the geopolitical risk was large enough to override the normal currency mechanics. Pay attention to that. Here is the data that makes this even more striking. U.S. 10-year Treasury yields are at 4.22% right now. That is a real positive yield. In a normal environment, positive real yields are one of the strongest headwinds gold faces, because gold pays no income, and a 4% Treasury yield is genuine competition for the safe haven dollar. The fact that gold is at all-time highs while Treasuries are yielding 4.22% tells you something specific and important. Investors are not buying gold as a yield substitute this week. They are buying gold as a geopolitical insurance policy. That is a different kind of buyer. And different kinds of buyers behave differently when conditions change. I want to be honest with you about something here before I go further, because this is where I have to be careful and where most channels are not. The decoupling is real. The data supports it. But decouplings do not last forever. The dollar-gold inverse relationship does not disappear permanently. It suspends temporarily under extreme conditions. The question that determines whether you are positioned correctly is not whether gold is strong today. It is whether the conditions driving the decoupling, active geopolitical risk and oil above 100, remain in place next week and the week after. That is the only honest framing I can give you. If you know someone who has been watching this gold rally and trying to understand why it keeps going up, despite the strong dollar, share this video with them right now. This is the explanation most channels are not giving them. The mechanics matter, and this breakdown took real time to put together. Now let me talk about what $100 oil actually means for the gold picture, because this is the layer most people are underpricing right now. When oil crosses $100 a barrel, it does not just affect petrol prices or airline tickets. It feeds into the cost of almost everything that gets manufactured, shipped, or grown. The Silver Institute and World Gold Council data both track the relationship between energy input costs and precious metals demand, and the pattern is consistent. Sustained elevated energy prices increase inflationary expectations, which increases the real return from holding gold as an inflation hedge, which brings in a second category of buyer on top of the geopolitical safe haven buyer. You now have two separate demand sources converging on the same asset at the same time. The geopolitical buyer and the inflation hedger are both reaching for gold this week. That is not one trade. That is two separate institutional decisions arriving simultaneously. From a UK perspective, this matters in a very specific way right now. The Bank of England has been navigating its own inflation challenge. Tracker rate mortgage holders in Britain are acutely sensitive to any inflation resurgence because it directly affects the pace and likelihood of Bank of England rate cuts. If oil at $100 feeds back into UK CPI, rate cuts get pushed further out, real household purchasing power stays under pressure, and the argument for holding gold as a store of value inside a SIPP becomes structurally stronger. This is not just a US story. British investors watching the LBMA gold benchmark this week are seeing the same dynamics playing out in sterling terms. The geopolitical layer here needs honest treatment rather than dramatization. Middle East escalation affecting oil supply routes is a genuine market risk, not because it guarantees a supply disruption, but because the futures market has to price the probability of one. The World Gold Council's research on gold's behavior during geopolitical stress events is consistent. Gold tends to spike in the first phase of escalation, and then the question becomes whether the underlying conflict sustains or resolves. Central banks in emerging markets have been adding gold to reserves at a historically elevated pace, according to the World Gold Council's most recent survey data. And those buyers are not day traders. They are not going to sell because of a single week of dollar strength. That structural floor underneath the gold price is one of the most important contextual facts you can have right now. De-dollarization is a decade-long structural process. It is not a Tuesday event, but the direction of travel is visible and documented. The industrial and monetary demand picture for gold remains intact beneath all of this. Gold's role in electronics, medical devices, and aerospace is real, but relatively stable. It is not the swing factor here the way solar demand is for silver. What matters more for gold right now is monetary demand. The CBO's latest long-term budget projections show the U.S. structural deficit continuing on a trajectory that historically has been one of the slow-burning tailwinds for gold as a reserve asset alternative. I am not saying the dollar collapses. I am saying the math is getting harder to ignore, and the central banks buying gold instead of treasuries are doing the same math. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market, the blue lane. COMEX gold futures this week are tracking spot closely with normal contango. No unusual stress signals in the futures curve itself. Open interest is elevated, but not at extreme levels, which tells me this is not a purely speculative paper move. The CME data supports that reading. Lane 2 is the physical market, the silver lane, though this week we are applying it to gold. Shanghai Gold Exchange spot at $5,208.40, $37.28 above Western spot pricing. That is physical demand from Eastern buyers paying a real premium to own gold now rather than wait. That is not paper. That is metal changing hands. Lane 3 is the macro lane, the gold lane. 10-year Treasury yields at 4.22%, dollar index at 99.70, oil above 100, active Middle East conflict. That macro backdrop is the most unusual combination I have seen in this market in several years. In 15 years watching currency and commodity markets, the times I have seen all three lanes align with this kind of intensity, physical premium, elevated futures interest, and extreme macro stress simultaneously, those have been some of the most significant periods in precious metals markets. I am not saying this continues indefinitely. I am saying the setup right now is historically unusual and deserves your full attention. When the paper lane shows stable elevated interest, the physical lane shows real Eastern premium, and macro is pointing toward simultaneous inflation and geopolitical risk. The historical pattern has leaned toward continued gold strength until one of those three conditions breaks. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. Oil. Specifically, whether crude holds above $100 into the end of the week or whether it pulls back below that level. The $100 level is not just a round number. It is a psychological and analytical threshold that changes the inflation narrative in real time. If oil holds above 100, the inflation hedge argument for gold stays structurally intact, and the two-buyer dynamic I described continues. If oil drops back below 95, one of those two buyer groups, the inflation hedgers, has less urgency, and you could see some profit-taking in gold even if the geopolitical picture stays tense. I will be watching the weekly crude inventory report from the EIA, the Energy Information Administration, published every Wednesday. That number will tell us whether the supply side of the oil story is tightening or loosening. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Oil holds above 100. Middle East conflict continues to generate genuine supply route risk that futures markets keep pricing. The Shanghai premium stays above $30, confirming Eastern physical demand is not retreating. The dollar starts to soften even modestly as geopolitical risk overshadows rate differentials. If those four things develop together, gold has a structurally supported path toward higher levels, and the 5,500 area becomes a realistic medium-term conversation. Here is what needs to happen for the cautious picture instead. A geopolitical de-escalation, a ceasefire, a diplomatic breakthrough, a meaningful reduction in conflict intensity, removes the war risk premium from gold almost immediately. History is very clear on this. Gold spikes on escalation and gives back a portion of those gains rapidly on de-escalation. Add to that an oil pullback below 95, and you could see gold retrace toward the 4,950 area without that representing any fundamental breakdown in the longer-term story. Both outcomes are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things. Before the two questions, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. Before we close, the disclaimer you need to hear. And I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. I want to ask you two things, and I genuinely want your answers. Not just a thumbs up. First, are you currently holding gold? And if so, Are you adding to your position at these levels or holding what you have? Whether you are in the US or the UK, drop that in the comments right now. This comment section becomes a real-time sentiment tracker, and I read every single one. Second, looking at the 3 lanes framework I just walked you through, which condition do you think breaks first? Oil, the geopolitical risk, or the Shanghai physical premium? Tell me your read below. Subscribe because next week we are going into exactly how to read the EIA weekly crude report as a leading indicator for gold. Most precious metals investors never look at energy data, and that is a mistake I'm going to fix for you. That is a skill worth having. And if someone in your life is watching the gold headlines right now and feeling confused about why the dollar being strong is not pushing gold down, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.